So listen, I'm not sure if this is part of the thing that sort of was a speed bump for the early rally fizzling out, but the Dallas Fed Manufacturing Survey, it saw general business activity swoon 22 points. It was a negative 8.3. The consensus was like 6, 7, depending on who you looked at. And the report pointed to increased uncertainty. But the comments, which I think is even better, right? You go in there, when these come out, you go and you look at what the comments are, and they were somewhat mixed, right? From the chemical area, you had someone saying the dynamics of tariffs, is tough. One other, though, said tariff threats and uncertainty are extremely disruptive. So one was good, one was bad. Same thing with chemical manufacturers, right? They want rates to be low. Please keep the rates low. They talk about the effects of the administration, stalling business and consumer spending. By the same token, some say we see broad signals of demand cyclically recovering. The economy is doing well, and many of them are pointing to government spending. They need government spending to go lower, energy prices and regulation. So I thought this is a great backdrop to bring in former National Economic Council, their chief economist, now SMBC's chief economist, Joe LaVorgna. Joe, let's talk about this. So this is sort of the mixed messages that we're getting on Wall Street. You're getting in a lot of surveys, whether it's manufacturing or services surveys. And it gets to a point that you keep making. People just don't understand tariffs.
They don't understand tariffs. But if we look at the uncertainty index, which is put out, I wrote about this a few weeks ago, and we see, Charles, what people are uncertain about. It's tax policy, it's fiscal policy. It's all the things the Republicans now are trying to get through the House and putting one big reconciliation bill through. And the sooner there's clarity on that, that will clean up some of this uncertainty. But yes, on the tariffs, it's become politicized. People don't understand it. That also probably for now is a factor that's weighing on people's optimism.
You know, it's so funny because last Tuesday and Wednesday we make record highs. And everyone's upset. Like Barron's like, yeah, it's a record high now, but just you wait. And then, of course, anytime the market's down, tariffs are killing the market.
Sure.
But we've seen this before, right? You can't say it's killing the market and then 3 days later at an all-time high. I think you lose credibility as a news organization. Let's stick with this report, though, because there's something in this report that I feel like I'm seeing a lot. So prices paid, this number is really starting to shoot higher and higher. Employment and wages and benefits are going lower. Are you worried at all? Is this stagflation? Is this a yellow flag, red flag?
Well, I'm a little bit concerned because if you look at that prices paid chart and you were to put prices received, what people are paying is going up and the price they're receiving is going down. So that does perhaps reflect some margin pressure. But again, Charles, there's a lot of uncertainty in terms of what future tax policy is going to look like. So the sooner there's clarity on that, the likelier companies can sort of settle and plan for the long term.
Let me, when it comes to manufacturing, when we get a real manufacturing renaissance, right, that's not just chips, but chemicals and all these other sort of hardline businesses. Does it automatically come with higher prices anyway? I mean, is that something to live with?
No. In fact, this is where tariffs are misunderstood because tariffs are an incentive to keep domestic production here, bring production abroad as well into the U.S. And the incentives, of course, would be low corporate tax rates, low regulation, and, of course, very low energy costs. And by the way, if energy costs move lower, a lot with those chemical manufacturers and others were saying, that will quickly change. So everything together does work for meaningful reindustrialization, but the policies need to be implemented. We can't wait any longer.
In the meantime, Doge isn't waiting. Doge has hit the ground running, and obviously the pushback is like severe. There's a lot of pearl clutching. And I thought it was interesting. So Starbucks today, which is a very liberal company, the greatest amount of layoffs I think they've ever announced, right? And the main reason, they have a new CEO who wants to streamline the business, and the stock went up because of that. Now, conversely, Palantir, which has become something of a proxy for the defense industry, that stock has been under a lot of pressure. The role of government spending and the idea of taking that out of the economy worries a lot of people. We know it hurts taxpayers. We know the interest that we're paying, but corporate America does benefit from it. How do you square that circle?
Well, I would say, look, Charles, if you look at the revenue numbers, and we don't have a revenue problem. Revenues are over 17% of GDP, in line to slightly above the long-term average. We have a government spending problem. That's what's driving these 6% plus deficits. So anything on Doge that is designed to get rid of wasteful spending, and by the way, the Doge numbers are very very reasonable if you compare them to the GAO. It has their own estimates of anywhere from 100 to 300 billion per annum of waste, fraud, and abuse. So if you deal with some of the government spending initiatives, while there might be a little bit of impact on demand in the short term, we get a little bit of pullback in measured GDP because government spending isn't as robust, you'll get much lower interest rates. Those lower interest rates will keep equity valuations elevated, and ultimately it's a much better and more productive environment.
So, Joe, when I talk, you've already mentioned getting these policies pushed through, right? We know it's imperative, and no matter what, right? Because these midterm elections, the last few cycles have been devastating for the sitting party. I was looking at what the election in Germany, which, by the way, AfD did extraordinary. They took from every single party. That little blue line down there is where they were in 2021. That's where they are now. They took a big chunk. But here's the thing. I read an article, it was going back last year, January, that they were trying to get rid of this with debt break. In other words, they have a rigid number, a limited amount of debt they can take on in Germany because of austerity prices. A lot of pressure to get rid of it, but the left thought it would be so they could spend more money on climate. What's the clock? How much appetite does a society, do you think America would have for sort of even government austerity without seeing a return?
Well, this is why President Trump has proposed giving some of the spending dividend back in terms of a check, which I think is a great idea, because people then see what pain they're incurring, they're getting something. They're getting something back.
Right.
In the case of Germany, I want to just mention, if you exclude the pandemic, the level of a German industrial production is back to the levels we last seen since April 2010.
It's crazy.
2010.
Yeah.
So you have an economy that has basically deindustrialized itself because its cost of doing business has become prohibitively high, and a large part of that is due to energy.
And mismanagement of energy policy. You shut down you have no drilling, you shut down all the nukes, and you import it's crazy. Hey, inflation. It feels like we're getting mixed messages. So the bond market's not acting crazy about tariffs or any of the headlines that's scaring maybe some investors. But on your tips are showing one thing, 10-year yield showing another. Which one should we be paying attention to?
Well, pay attention to the break even, which is the inflation number. I believe we're going to get energy costs down, and energy costs, as I've mentioned many times before, will act as a big downward pressure on break even rates, and it will also give households money. They'll increase their purchasing power. The growth side's fine. The growth is going to be good. We need inflation down, and that's where break-even inflation, you'll see it first. But again, to get that, Charles, you need supply-induced tax cuts, business regulation, and, of course, those low energy costs, and you'll be fine on the inflation side.
All right, the good news is a lot of members of Congress watch this show. Folks, get moving. Joe, thanks a lot.
Thank you, Charles.